Hello, today is Monday, the 12th of January, 2009, and this is Brian Shannon from AlphaTrends.net. We had sellers here once again at this is the NASDAQ 100, finished with a loss of 55 cents or 1.8%. We can see here on the daily time frame that it did close below the widely watched 50-day moving average, and the bullish argument is actually rapidly losing any merits here. This is going to be a very important level, about 28.5. Here over the next several weeks, as it has been an important level of support and represents where we would see a lower low on the daily time frame. We're still in this little pattern here over the last several weeks of higher highs and higher lows, and right now we're experiencing a pullback which has exceeded that two-thirds retracement level. So once again, the Fibonacci levels are an area to look for the potential of buyers to show up, but if they don't show, then there's no point in they're just another technical tool to say here's a potential area where the buyers may show up. What's more important than Fibonacci or anything moving average or anything like that is the pattern of lower highs and lower lows, which has been present in here and continues to be present, and it's enough so that it's moved the 5-day moving average to a downward momentum in here, and we typically see that the market needs to flatten out, or that is the 5-day moving average needs to flatten out, and the market needs to hold above it before any real rally can take hold. So odds don't favor longs in here. We've gotten sold out pretty quickly here over the last week or so. We're at this prior level of resistance, which had been support for this rally. So I think that this level is going to be an important area. It's also, as we see here, the basis of this trend line, which you can see it does have further merit when we back it up onto the hourly time frame. So we're looking here at obviously what this really turns out to be on the daily time frame is this little channel basically that we've been in here. And when we look at that on the weekly time frame, this is what I was pointing out Friday, that you have the potential here that we're creating a bearish flag, which it would obviously be a big negative, and I think what would confirm that bearish flag would be a close below that $28.50 level. It's hard to imagine that this market is going to turn higher and rally. Last week, I think that was as best a chance as the buyers had to really continue to push this market higher here. As I said, it was looking like it had the potential to be bullish Wednesday and Thursday of last week as it held above that 10, 20, and 50-day moving average, but it never confirmed on that 10-minute time frame by making a higher high. So any bullish argument here is based on nothing more than hope at this point, but as we've seen, we are in a very volatile environment driven by a lot of news headlines, and we've got to be quick to act, but right now you've got to just continue to be very defensive in here. So 28.5 will be very important here over the next several sessions. At least the next few days, I think. This level here as well, again, that's about 29.25. It's where we see this trend line, and it's where we've seen this prior resistance turn into support here. So you've got about 29.25 and then down to 28.50. Breaking below that, then we might end up similar to what's been happening in the financials. Let's take a look at them next, because this is the group that of course has like I've been saying, the potential to drag the whole rest of the market lower. We've got that declining highs in here, and the declining 50-day moving average, which this market was unable to recapture last week when the rest of the markets did. And now we broke decisively below that $11.40 level. That $11.40 level has been taken out on a closing basis. Next potential level of support is about $10.40, and then perhaps we're going to go test these lows. Citigroup is broken. Goldman Sachs is under pressure. Bank of America. They're all obviously going to look pretty similar here. But the bottom line is the financials are in big trouble here with this move below that $11.40 level, and basically the close below it. If for some reason somehow it gets back above this 1140 level, maybe on some big news and volume, then I think you want to be very careful with your shorts. But right now, the path of least resistance continues to be lower in these financials, and again, that 1140 will be critical for the market, maybe getting back above that, we can see something. But our next potential areas where we may find buyers, about $10.40. And then, basically in this gap somewhere down near 10, and then again a test of the lows. The oil was down. We were seeing signs of big volume and some moving averages crossed last week, but as I said, with a declining 5-day moving average, you want to stay very cautious as far as getting long in here. This market has been showing this pattern of consistent lower highs and lower lows, and there's no advantage to being long in a declining environment, and that's what we see here obviously for oil. Oil looks like perhaps it's tested, headed for a test of these lows. Let's see what happens if it gets there, but right now odds do favor further downside. We're at a potential area where this prior resistance, where this most recent rally right here began from. Perhaps we're going to find some support there. It looks like we're just holding just above it. Below that, we've got about $29 even, and then of course the lows were just under $28 for the USO, and we're going to have to do some healing. I think probably at least get back above there, see this 5-day moving average kind of flatten out before it can continue higher, or start to try to turn higher again. The rallies with a declining 50-day moving average typically do fail. So the semiconductors, obviously this group remains in big trouble as well. We've got this trend line that we've closed below. I think more important is this little support right in here that we've seen at about $16.40 or so. If we take a look here, it's about $16.60, maybe $16.50 to $16.60, let's say. If the market comes down there, maybe it's going to find buyers, but with all these other markets showing the weakness that they're showing, there's no reason to be purchasing, definitely. And right now, the odds don't even favor looking for support in that level yet. So you got to just continue to focus on the shorter term trends. Unless I guess you're more of an investing bear, but we've got this bearish looking flag in here, and odds do favor further downside, I guess, in really all these markets. The Russell 2000 was down $1.43. We've got the potential for some support right down just under that $46 level. Let's look at that on a 30-minute time frame. So just under 46, right around 45.90, 46. Right in that area, potential support. We've got, let's back that up to an hourly time frame. Here's an important trend line that was obviously broken today, but then just below that, we've got this $46 level. So if 46 breaks, then you can start to look at some of these other spike lows down near 44, 44.10, I guess, is that area. And we've got this pattern now in here on these, on the Russell, where we'd seen the higher lows and higher highs. Now we've got this lower high, and we've got looking like lower lows as well. In particular, if we break this level, then things could get very ugly very quickly. You have to remember when you're trading in an overall bear market, and an overall bear market is defined on the weekly time frame. Any long trades, you can get several week uptrends, but these long trades have to be managed very aggressively. You can't believe that was the worst of it until we've seen a much longer healing process that just it takes a lot of time. And again, look at my blog under that popular post and look at those historical charts of 1929. Things can get a lot worse here. I'm not going to make that prediction, but things can get a heck of a lot worse here. And our job is just to manage risk and trade the trends as they reveal themselves to us, and try not to get our opinions in the way. Lower highs and lower lows in here, all the way down, from these highs, and we're trapped below a declining 5-day moving average on the Russell. It doesn't, make sense to be looking for those long plays in there. I fall for it sometimes too. I tried nibbling on some Q calls in here today. Realized it was stupid and took a small loss, but just try to stay as disciplined as possible and not look at the potential for or think that, well, it's down too much or it's due to rally, or, well, I'll give it a shot here because it's at that Fibonacci, which is what I did. If you fall for those types of moves, you have to recognize them quickly and move to the sidelines, and realize that our job is, when we're not trading well, to preserve capital and have it available for the next good trade that reveals itself. The S&P 500, obviously we have the failed breakout here, past the resistance at $92.40, 92.5, I guess it was, and here we are back down to the low end of this range. And are we going to break this time? If we do break below this 85 level, then things in the S&P could, we could see 81 or so, and then maybe even a test of those lows once again. The weekly time frame still looks pretty bearish in here. That move, with a move below this level in here, could be very damaging to the market. The only thing you can say here is that we're down pretty quickly, but that's definitely not a reason to be a buyer. Maybe it's too late to initiate short sales, but from an intraday standpoint, on the 1 minute time frames, there's always going to be opportunity present in here if you're disciplined enough to find it at the right times.